What if I told you that you don't need to be rich to start investing? You don't need a finance degree, and you definitely don't need to time the market like some Wall Street genius. In fact, most people who build real wealth don't do anything fancy at all. You just start early, stay consistent, and avoid a few big mistakes. But here's the problem. Most beginners never start investing because they're confused, scared, or overwhelmed. They hear words like stocks, ETFs, dividends, crypto, market crashes, and they freeze. If that sounds like you, stay with me. Because in this video, I'm going to break down investing for beginners in the simplest, most practical way possible. No hype, no get-rich-quick nonsense. Just real, proven investing principles that normal people use to build wealth over time. By the end of this video, you'll know how investing actually works, where beginners should invest, and where they shouldn't. The biggest mistakes that destroy wealth, and how you can start investing confidently. Even with little money, let's get started. And why IT matters before we talk about how to invest. Let's clear up something important. Investing is not gambling. Gambling is guessing. Investing is owning. When you invest, you're buying a piece of a real business, a collection of companies, or a real asset that grows over time. Think about it like this. Saving money is like parking your car. Investing is like putting your money on a journey. If you only save money, inflation slowly eats it away. Your money loses value every year. But when you invest, your money has the chance to grow faster than inflation, helping you build real wealth. That's why investing is so important. It's not just for millionaires, but for everyday people who want financial freedom, a comfortable retirement, less stress about money, and more control over their future. Section 2. Why most beginners fail at investing. Here's a hard truth. Most beginners don't fail because investing is hard. They fail because they overcomplicate it. They chase hot stocks, follow social media gurus, panic when markets fall, or expect quick profits. Let me be very clear. Investing is a long-term game. If you're looking to get rich overnight, investing is the wrong place. But if you're willing to be patient, disciplined, and consistent, investing can change your life. Section 3. The first rule of investing: start early. This is the most powerful investing rule. Start early. Time is more important than talent. Let's say to people invest. Person A starts at age 25, person B starts at age 35, both invest the same amount every month. Guess what? Person A will likely end up with much more money, even if person B invests more aggressively. Why? Because of compound interest. Compound interest is when your money earns returns. And then those returns earn returns. And then those returns earn even more returns. Albert Einstein allegedly called it the eighth wonder of the world. And honestly, he wasn't wrong. Section 4. You don't need a lot of money to start. One of the biggest lies beginners believe is, I'll start investing when I have more money. That's a mistake. You can start investing with $1,050 or even less. Many platforms allow fractional investing, meaning you can buy a small piece of a stock or fund. The amount matters far less than the habit. It's better to invest a small amount consistently than a large amount once. Section 5. Emergency fund. Before you invest a single dollar, do this first. Build an emergency fund. An emergency fund is money you keep aside for medical emergencies, job loss, unexpected expenses. This money should be easy to access, kept in cash or a savings account. Why is this important? Because if you invest without an emergency fund, you might be forced to sell your investments at the worst possible time during a market crash. A good rule of thumb: 3 to 6 months of living expenses saved before investing seriously. Section 6. Understanding risk. Very important. Every investment has risk. The goal is not to avoid risk, it's to manage it. Generally, higher risk equals higher potential return. Lower risk equals lower potential return. As a beginner, you don't want to take extreme risks. You want balanced, diversified investments. And that brings us to one of the most important concepts in investing. Section 7. Diversification. Don't put all your money in one place. Never put all your money into one stock, one company, one asset. Why? Because if that one thing fails, you lose everything. Diversification means spreading your money across different companies, different industries, different asset types. This reduces risk and smooths out returns over time. Section 8. Best investments for beginners. Now let's talk about where beginners should invest. 1. Index funds and ETFs. For most beginners, this is the best place to start. Index funds and ETFs track the overall market, are low cost, are diversified, require little effort. Instead of picking individual stocks, you own hundreds or thousands of companies at once. This reduces risk and stress. 2. Dividend-paying investments. Dividend investments pay you regular income. Even if the market goes up and down, dividends provide cash flow stability, long-term growth. Reinvesting dividends can significantly boost your returns over time. 3. Retirement accounts, if available. If your country offers tax-advantaged accounts, use them. These accounts reduce taxes, encourage long-term investing. Help you retire comfortably. Always take advantage of any employer match if available. It's basically free money. Section 9. Investing strategy for beginners. Here's a simple, beginner-friendly strategy. Invest regularly, monthly or weekly. Use diversified funds, hold long-term, ignore short-term noise. This strategy beats most active traders over time. Section 10. Market crashes. Don't panic. Market crashes are scary. But here's the truth. Market crashes are normal. Every major market crash in history was followed by a recovery. Beginners panic and sell. Smart investors stay calm and sometimes even invest more. The market rewards patience. Section 11. Biggest mistakes beginners make. Avoid these mistakes at all costs. Chasing hype stocks, investing money you'll need soon, panic selling. Overtrading, trying to time the market, listening to social media experts. Slow and steady wins the investing race. Section 12. Investing vs trading. Let's clear this up. Investing equals long-term ownership. Trading equals short-term speculation. Most beginners should focus on investing, not trading. Trading requires experience, emotional control, time, and skill. Investing is simpler, safer, and more reliable for beginners. Section 13. Mindset. The real secret to investing: your mindset matters more than your strategy. Successful investors think long-term, stay disciplined, ignore noise, stay consistent. If you can control your emotions, you're already ahead of most people. Section 14. How to start investing today, step by step. Here's a simple action plan. Learn the basics, build an emergency fund. Choose a beginner-friendly platform. Start with diversified funds. Invest consistently. Stay patient, that's it. No stress. No confusion, just steady progress. If you've watched this far, you're already doing better than most people. Remember, you don't need to be perfect, you just need to start investing. It's one of the most powerful tools you'll ever use. If this video helped you, like it, subscribe, and share it with someone who's just getting started. Your future self will thank you.